Imagine a company where the same auditor audits for 25 years. No independence, no accountability, and no questions asked. Can such financial statements really be trusted? Let's decode Section 139 in a simple and practical way. This section focuses on the appointment and rotation of auditors to ensure transparency and integrity in financial reporting. We'll explore the key provisions, the importance of auditor rotation, and real-life examples that highlight the impact of these regulations. By the end of this video, you'll understand how Section 139 protects stakeholders and enhances trust in financial statements. Let's dive in. Hello everyone, welcome to Corporate and Securities Law Compass. In today's video, we will cover who an auditor is, the appointment of an auditor under Section 139, the differences between a first auditor and subsequent auditors, the rotation of auditors, the rules under the Companies, Audit and Auditors Rules 2014, and practical examples for clarity. Let's begin. Before we understand Section 139, let's first address a very basic but important question. Who is an auditor? An auditor is an independent professional who examines the financial statements of a company and gives an opinion on whether they present a true and fair view. Now let's simplify this. In simple words, an auditor is a watchdog, not a bloodhound. What does that mean? An auditor is expected to be alert and careful, but not to go out of the way to hunt for fraud. He verifies what is presented, questions what looks unusual, but he is not an investigator by default. As per law, an auditor is typically a chartered accountant in practice who is appointed under the Companies Act 2013 to audit the books of accounts of a company. Let's understand this with a practical example. Suppose a company reports a profit of 10 crore rupees. Now the auditor steps in. He does not blindly accept this number. Instead, he verifies, is the revenue actually earned or just recorded on paper? Are all expenses properly accounted for? Are there any unusual transactions? Is there any sign of fraud or manipulation? So remember, an auditor does not create financial statements. He examines them and gives an independent opinion. Now that we clearly understand who an auditor is, let's move to Section 139 and see how auditors are appointed. Now that we understand who an auditor is, let's move to the core provision, Section 139 of the Companies Act, 2013. This section is the foundation for understanding how auditors are appointed in a company. It lays down the complete framework from appointment to rotation to tenure. Section 139 mainly deals with four important aspects: the appointment of auditors, the tenure of auditors, the rotation of auditors, and the applicability of these provisions. First, appointment. This tells us who appoints the auditor. Is it the board of directors or the shareholders? And at what stage? Second, tenure. This answers an important question: for how long can an auditor continue? Is it 1 year, 5 years, or more? Third, and most critical, rotation of auditors. This ensures that the same auditor does not continue for too long, which could affect independence. And fourth, applicability. This tells us to which companies these provisions apply. Now here is a very important point. Section 139 applies to all companies, whether it is a private company, a public company, or even a listed company. So no company can say we will appoint auditors as per our own choice without following the law. every company must comply with Section 139. But why is this section so important? Because auditors play a key role in ensuring transparency, maintaining investor confidence, and preventing financial misstatements. If the appointment process is not regulated, the entire financial reporting system can be compromised. So now that we have a clear overview of Section 139, let's move step by step and first understand the appointment of the first auditor. Now let's move to the first practical application of Section 139. Appointment of the first auditor. As per Section 139, subsection 6, every company must appoint its first auditor within 30 days of incorporation. Now the important question, who appoints the first auditor? The answer is the Board of Directors. So remember this clearly, the first auditor is appointed by the board, not by shareholders. But what if the board fails to appoint within 30 days? In that case, the members, that is, the shareholders, will appoint the first auditor. And they must do so within 90 days. So the flow is very simple, first 30 days board. If board fails, next 90 days members. Now let's understand the tenure of the first auditor. The first auditor will hold office till the conclusion of the first annual general meeting. So this is a short-term appointment, only to ensure that the company has an auditor from the beginning. Let's understand this with a practical example. ABC Private Limited is incorporated on 8th April. Now the Board of Directors must appoint the first auditor within 30 days, that is, on or before 30th April. But suppose the board fails to do so. Then what happens? In that case, the shareholders will step in and they will appoint the auditor within 90 days. So even if the board fails, the law ensures that the company is never without an auditor. This provision ensures timely appointment, continuity in audit, and compliance from day one. Many students make a mistake here. They think shareholders appoint the first auditor. That is incorrect. Always remember, first auditor board. Only if board fails members. Now that we clearly understand the first auditor, let's move to the appointment of subsequent auditors, which is slightly different and very important. Now that we have understood the concept of the first auditor, let's move to the next important concept, appointment of the subsequent auditor under Section 139, subsection 1. In this case, the auditor is appointed by the members of the company in the annual general meeting, also known as the AGM. So remember the key difference, first auditor is appointed by the Board of Directors, while the subsequent auditor is appointed by the members in AGM. Now let's understand the tenure. Once appointed, the auditor holds office for a period of 5 years. To be more precise, this is from the conclusion of one AGM till the conclusion of the 6th AGM. So in simple terms, it's one appointment for a 5-year tenure that covers 5 financial years. Earlier, the law required ratification of the auditor's appointment at every AGM. That means, even though the auditor was appointed for 5 years, members had to confirm the appointment every year. But this requirement has now been removed. So currently, no annual ratification is required, and the auditor continues for the full term unless removed or disqualified. Let's understand this with a practical example. At the AGM held in 2025, XYZ Limited appoints Mr. A as its auditor. Now, Mr. A will hold office till the conclusion of AGM 2030. So the tenure will be from 2025 to 2026, 2026 to 2027, 2027 to 2028, 2028 to 2029, and 2029 to 2030. That is a complete 5-year term. During this period, there is no need for yearly approval, and the auditor continues unless he resigns, is removed, or becomes disqualified. Many students get confused here, thinking the term is till the Panch eth AGM, but that is incorrect. The correct concept is from the ek cent AGM till the Chhe eth AGM. This provision ensures stability in audit, continuity in financial review, and accountability through member approval. Now we have understood the first auditor and subsequent auditor. Let's move to the most important and practical concept, rotation of auditors under Section 139(2). Now let's come to the most important concept under Section 139. Rotation of auditors. This is not just important for exams. It is a core principle of corporate governance. But first, ask yourself one question. What happens if the same auditor continues for 15, 20 or 25 years? Over time, familiarity increases, independence reduces, objectivity may be compromised. That's why the law mandates rotation. Now let's understand where rotation is applicable. Rotation of auditors is mandatory for listed companies and certain prescribed classes of companies based on paid-up capital, turnover, or borrowings. So this is not optional. It is compulsory for specified companies. Now understand the core rules. For an individual auditor, maximum term is 5 consecutive years. For an audit firm, maximum term is thus consecutive years. Remember it like this. Individual equals Panch, firm equals thus. Now comes a very important concept. Cooling period. After completion of the maximum term, the auditor cannot be reappointed for 5 years. So even if the company wants, they cannot continue with the same auditor immediately. Let's understand this with a practical example. Mr. X is appointed as auditor of a listed company in 2020. He can serve till 2025. After 2025, he cannot continue. A new auditor must be appointed, and Mr. X can be reappointed only after 2030. Now let's take an audit firm. Audit firm ABC Co. is appointed in 2020. They can serve till 2030. After that, rotation becomes mandatory. The company must appoint a new audit firm. This provision ensures fresh perspective, independence of audit, better corporate governance. Many students forget the cooling period. Always remember, after 5 or 10 years, cooling period of 5 years is compulsory. Let's revise quickly. Individual 5 years, firm 10 years, cooling period 5 years. Now that we have understood rotation, let's move to the procedural rules. Under the Companies Audit and Auditors Rules, 2014. Now let's come to the most important concept under Section 139. Rotation of auditors. This is not just important for exams. It is a core principle of corporate governance. But first, Ask yourself one question. What happens if the same auditor continues for 15, 20 or 25 years? Over time, familiarity increases, independence reduces, and objectivity may be compromised. That's why the law mandates rotation. Now let's understand where rotation is applicable. Rotation of auditors is mandatory for listed companies and certain prescribed classes of companies based on paid-up capital, turnover, or borrowings. So this is not optional. It is compulsory for specified companies. Now understand the core rules. For an individual auditor, the maximum term is 5 consecutive years. For an audit firm, the maximum term is thus consecutive years. Remember it like this. Individual equals branch, firm equals thus. Now comes a very important concept. Cooling period. After completion of the maximum term, the auditor cannot be reappointed for 5 years. So even if the company wants, they cannot continue with the same auditor immediately. Now that we have understood appointment and rotation, let's move to the procedural requirements under the Companies, Audit and Auditors Rules 2014. These rules ensure that the appointment of an auditor is not just a formality, but a legally compliant process. First requirement: the auditor must give written consent. This means the auditor must formally agree to act as auditor of the company. So without consent, the appointment is not valid. Second requirement: a certificate confirming eligibility. This certificate ensures that the auditor is qualified under the law, he is not disqualified under the Companies Act, and he satisfies all prescribed conditions. This is very important because not every chartered accountant can act as auditor in every case. Third requirement: filing of Form ADT with the Registrar of Companies. This form contains details of the appointment and must be filed within the prescribed time. So even after appointment, compliance is not complete until ADT is filed. Let's understand this with a practical example. Suppose a company wants to appoint Mr. E as auditor. Before the appointment becomes valid, Mr. A must confirm the following: he is not disqualified under the Companies Act, he is within the limit of audit assignments, and he is eligible to accept the audit. Then, he gives written consent, he submits the eligibility certificate, the company appoints him in AGM, and files Form ADT with ROC. So remember, the appointment of auditor is a two-way process. The company appoints, and the auditor confirms eligibility. Many students think appointment is complete at AGM, but that is not correct. Final compliance includes consent, certificate, and ROC filing. Let's revise quickly: consent of auditor, eligibility certificate, Form ADT1 filing. Now that we have understood the rules, let's move to some important concepts like casual vacancy and reappointment. Now let's quickly understand some very important concepts. These are small but highly exam relevant. First, casual vacancy. A casual vacancy arises when the auditor's position becomes vacant before the expiry of his term. This may happen due to resignation, death, or disqualification. Now the key rule: casual vacancy is filled by the board of directors. But there is one important exception. If the vacancy is caused due to resignation, then it must be approved by the shareholders in a general meeting. So remember this clearly: normal vacancy means the board fills it, while resignation requires shareholder approval. Suppose an auditor resigns mid-year. The board will propose a new auditor, but final approval must come from shareholders. Now let's move to reappointment of auditor. At the end of the auditor's term, he is automatically reappointed. Yes, automatically. No fresh resolution is required in normal cases. But this automatic reappointment will not happen if the auditor is not qualified, the auditor becomes disqualified, or the company passes a resolution appointing someone else. So in simple terms, if everything is fine, the auditor continues. If any issue arises, a new auditor is appointed. These provisions ensure continuity in audit, flexibility in replacement, and protection of shareholders' interest. Many students confuse this. They think every year a fresh appointment is required. That is incorrect. Reappointment is automatic unless specific conditions apply. Let's revise quickly. Casual vacancy means the board fills it. Resignation case requires shareholder approval. Reappointment is automatic, and exceptions include disqualification or resolution. Now that we have covered all key concepts, let's quickly revise the entire section 139 in a short summary. Now, before we conclude, let's quickly revise the entire section 139. In just a few seconds. First auditor is appointed by the board of directors. Second, subsequent auditor is appointed by the members in AGM. Third, tenure of auditor is generally 5 years, i.e., one term of 5 years each, or 10 years for firm for 2 term of 5 years each. That is, till the conclusion of the 6th AGM. Fourth, rotation of auditors is mandatory for listed companies and certain prescribed classes. Fifth, procedural rules require consent of auditor, eligibility certificate, and filing of Form EDT1 with ROC. So if you remember these 5 points, you have understood section 139 completely. And trust me, these points are frequently asked in exams and also very important in practice. So always keep in mind. Board members, 5 years or 10 years rotation. Compliance rules. Now let's wrap up this video. So that's all for today. If you found this video helpful, make sure to like this video, share it with your friends and colleagues, and subscribe to the channel Corporate Securities Law Compass. Because on this channel, we simplify complex provisions of corporate and securities law in the most practical and exam-oriented way. And in the next video, we will cover section 140, removal and resignation of auditor, which is equally important and very practical. So don't miss it. I'll see you in the next video. Disclaimer: viewing this video or accessing the content on this channel are free and does not create any professional, advisory, or client relationship between the speaker and the viewer. The content is shared solely for general educational and informational purposes. The speaker is a member of the Institute of Company Secretaries of India, ICSI. However, the information provided in this video should not be construed as professional advice, consultancy, or opinion under any law or regulation. Viewers should not rely solely on the information provided in this video for making legal, financial, regulatory, or compliance decisions. Any person intending to rely upon or act on the information contained herein should independently verify the relevant provisions of law and, where appropriate, Seek professional advice from a qualified professional. The speaker, the Institute of Company Secretaries of India, ICSI, and any organization or listed company with which the speaker may be associated shall not be liable for any direct or indirect loss, damage, or consequences arising from reliance on the information provided in this video or channel. The content shared on this channel is based solely on publicly available information, general legal provisions, and academic discussion of corporate and regulatory frameworks. The speaker confirms that no unpublished price-sensitive information, UPSI, confidential information, or proprietary information of any listed company or organization has been disclosed or discussed in any video or content on this channel. The views expressed in the videos are personal academic interpretations for educational purposes only and are not connected with or derived from any confidential information obtained through employment, professional engagement, or association with any listed company or organization. Nothing contained in this channel should be interpreted as market advice, investment advice, or insider information under the applicable provisions of securities laws including the SEBI, prohibition of insider trading, regulations. Though 015. Viewers are advised that the information shared is purely for general educational awareness and should not be relied upon for investment decisions, trading decisions, or regulatory compliance without consulting appropriate professionals and official sources.